Getting a mortgage, it can feel like you're trying to solve a puzzle in a language you don't speak, right? But what if I told you there's a secret rule book? And it's not there to trip you up, it's actually there to protect you. Today, we're gonna crack that book wide open.
I mean, we've all been there. You're staring at this absolute mountain of paperwork, your eyes are glazing over, and you're just hoping that you're making the right call. That feeling of being totally overwhelmed, yeah, it's pretty universal.
Well, that's where this rule book comes in. And we're not just gonna read it to you. That would be boring. We're gonna give you the cheat codes. Seriously, simple, memorable tricks that'll help you understand exactly what your rights are as a home buyer. All right, let's dive into part one. This is the big one, the question that everything else is built on. Before a lender can even think about giving you a loan, they have to answer one simple thing. Can you actually afford to pay this back? This is called the Ability-to-Repay Rule, or ATR for short. You can think of it as the very first line of defense. It basically says, hey lender, hold on. You can't just throw money at someone. You have to do your homework and make a real good faith effort to make sure this loan isn't going to sink them. So how do they do that homework? Well, they're required to give you a full financial physical. They have to look at these 8 specific things. We're talking your income, your job situation, what this new mortgage payment will be, any other mortgages you have, taxes, insurance, your credit history, and all your other debts. It forces them to see the entire picture, not just one piece of it. Okay, I know what you're thinking. How in the world am I supposed to remember all 8 of those? Don't worry, we got you. Here is your very first cheat code. Just remember this silly sentence. I eat my other tasty donuts carefully daily. The first letter of each word lines up perfectly with one of those 8 factors. Go ahead, try it. It works, and you'll never forget it. Now, when a loan passes that 8-point inspection with flying colors, it can get a special label. It's called a qualified mortgage, or QM. Think of a QM as the gold standard. It's considered safer, more stable, and it creates this safe harbor of protection for both you and the lender. And the difference is pretty stark. On one side, you have the qualified mortgage. It has guardrails, no weird, risky features, a cap on fees, and your income has to be thoroughly checked. On the other side, you have non-QM loans. Now, they can offer more flexibility, which isn't always bad, but that can sometimes mean riskier things like interest-only payments. So how do you remember what makes a QM a QM? Another cheat code for you, and this one's super easy. Just think QMs are CIP. They have clean, straightforward terms, your income is always verified, and they're protected. CIP. Simple as that. Okay, so we've covered part 1. The lender has determined you can afford the loan. But that brings us to a whole new question, doesn't it? Is the loan itself just way too expensive? Well, you guessed it, there are rules for that too. And this is where a rule called HOEPA comes into play. It stands for the Home Ownership and Equity Protection Act. But all you really need to know is that its job is to act like a giant red flag for any loan that's considered high cost. If a loan's terms are so expensive that they trigger HOEPA, a whole new set of shields go up to protect you. So what triggers it? Well, the first trigger is the interest rate. There's a benchmark rate out there. Think of it as the average rate for a low-risk borrower. If the APR on your loan is more than 6.5 percentage points higher than that benchmark, bam, it's automatically a high-cost HOEPA loan. The other big trigger has nothing to do with the interest rate. It's all about the fees. If the points and fees you're paying right up front add up to more than 5% of your total loan amount, that sets off the alarm bells too. It's a really clear line in the sand to prevent lenders from packing a loan with excessive fees. And when that alarm goes off, what happens? You get backup. You're required to get pre-loan counseling from an independent housing expert, and the lender is flat out banned from including risky features like big balloon payments at the end. The cheat code? Just think of the name. HOPA. High over everything, pay attention. The rule is literally telling you to pay extra close attention to this loan. Now, don't get HOEPA confused with its close cousin, the HPML, which stands for Higher Priced Mortgage Loan. You can see here the trigger is much, much lower, just 1.5% over that average rate. So these loans aren't quite high cost, but they're still pricier than average and they catch a much wider net of mortgages. For these higher priced loans, you get a different set of protections. The biggest one is a mandatory escrow account for at least 5 years. This makes sure your property taxes and homeowners insurance get paid, no surprises. Plus, a full appraisal is always required. The cheat code here is high price means lock-in. You're locking in that safe escrow account for the long haul.
All these rules are really about making sure the incentives are in the right place. And that brings us to a huge one, the Loan Officer Compensation Rule. The idea is simple. It makes it illegal for your loan officer to earn a bigger commission by pushing you into a more expensive loan. Their job is to find you the right loan, not the one that makes them the most money.
And we have a cheat code for this one. It's don't S.T.E.E.R. It breaks down like this. A loan officer can get a salary, but they can't get paid based on the loan's terms. Either their employer pays them or you, the borrower, pay them, but never both. And the responsibility to follow these rules is on them. It stops them from steering you into a bad deal. All right, deep breath. We're in the home stretch. Your loan is affordable, the costs are fair. Now we're talking about the final timeline, the days leading up to closing, when you finally get the keys. And believe me, the timing here is absolutely critical. And there's a rule book for that too.
This whole closing process is governed by a rule called TILA. Now, before TILA, it was chaos. Borrowers would get a whole stack of confusing, overlapping forms thrown at them right at the closing table. TILA cleaned all that up. It created two simple documents, the loan estimate at the beginning and the closing disclosure at the end, so you can easily see if the final numbers match the first quote. The whole point? No more last-minute surprises, period.
And the cheat code for TILA is one of the most important of all. It's the 3-3-3 rule. It's all about giving you time to think. First 3, you have to get your loan estimate within 3 business days of applying. Second 3, and this is the big one, you must get your final closing disclosure at least 3 full business days before your closing date. That is a mandatory cooling off period. And the final 3, if a major number changes at the last minute, like the APR, that 3-day clock resets, giving you time to review everything again. It puts all the power back in your hands. So, we have covered a ton of ground. But the whole time, you've been collecting these little cheat codes. Let's pull them all together and look at the new toolkit you have at your disposal. Let's do a lightning round. For Ability-to-Repay, you're going to eat your tasty donuts. For a safe loan, remember that QMs or CIP. For your loan officer, tell them, don't S.T.E.E.R. If a loan is really expensive, remember HOEPA. High over everything, pay attention. For those middle ground loans, HPML. High price means lock in that escrow account. And for your closing timeline, you own the 3-3-3 rule. See? These aren't just little tricks. They're tools that give you confidence. Look, the mortgage process seems complicated, but it's not some unknowable mystery. It has a rule book designed to help you. And now you have the cheat codes. So the only question left is, with this new toolkit in your back pocket, what are you going to ask the next time you talk to a loan officer?